Hey guys, Toby Mathis here, and today we're going to talk about what are audits and how you can make sure that you're never audited, aka who gets audited, how we can make sure it's not you. So let's dive right on in. First off, there's a lot of misconceptions about what an audit is. They always people think like the IRS showing up at your house, knocking on your door, demanding to see all your books and records. It's not like that, right? It's usually a letter. More than likely, it's a correspondence audit. In fact, I'll go over what the percentages are. The vast majority are correspondence audits, where there's something that the IRS needs clarity on your return because something might not be matching up with something somebody else provided, or they just need more information. Here's an easy rule: don't ever represent yourself in an audit. Let somebody else deal with it. Let a accountant do what they've been trained to do and be that buffer between you and an agent. You never want to sit down and just have somebody might just decide they're going to make their case or their whole career on your back. You don't ever want to be that. You want to show that you have the sense to hire professionals. The old adage in the lawyering, I'm a tax attorney, is, anybody who represents themselves has a fool for a client. And there's no different here. You should be having somebody else prepare your return, and you should make sure somebody's representing you in the unlikely event you're ever audited. So let's go into how the heck do you get picked in this audit lottery? How do you go through it? And I'm going to give you two pieces of information. Number one, you could go look at this one, and it's a publication. I'm just going to call it Pub 55. And this gives you all the data every year. There's a ton of tables. I usually go to 17 and 18. There used to be something called 17B, which would break down the audit rates for specific forms on the return. So like if you were a sole proprietor making 100 to 200,000, I could see exactly what your audit rate is, who gets audited. For the most part, we're just looking at those and we're seeing which groups are being audited so we can see which group you don't want to be a part of. And there's another system that the IRS uses, and it's called the discriminant, and I'm just going to write it up for you, the discriminant function system, but everybody just calls it DFI. And so if you hear me ever say DFI, that just means the IRS has lots of history, and they know the earmarkings of people that don't report their income, who have a higher likelihood of needing to be audited, like where there's more than likely questions. Like the old joke was kind of like, what was it? Car washes and things like that, cash intensive business. You put a bullseye on your back. We know, for example, that traders and securities, for whatever reason, have a bullseye on their back right now. But there's historic data, and they do what's called a point system. Nobody knows what the point system is, but if your return has certain types of categories listed, it gives you a certain amount of points. Or if you have, for example, really large charitable contributions compared to your salary, you might be given a point total. And all the IRS then does is say, hey, we're going to take the returns with the highest points. We're going to take a look at them. Doesn't mean they're marching you out and hanging you. Doesn't mean that you're going to the executioner, right? It means that they're going to take a look at your return and they're going to want to see some backup. And it puts the ball into your court, which then you have this information, it puts the ball back in their court. And that's why, I've never seen an audit really go awry in 25 years. Haven't seen an audit go awry because businesses should be keeping books. People that are making stuff up don't have books, right? And those are the ones that get in trouble. And the IRS is just trying to identify who it is. Right now, by the way, the group that gets audited the most, it is, let's say that you and I equal X. The group that is 5X, 5 times more likely than the rest of us to get audited, is people making less than $25,000. You want to get audited, make less than $25,000, because those are the folks that are getting hit the hardest right now. Other groups that I see that get audited quite often, I mentioned traders and securities. The reason that traders and securities, in my opinion, get audited, because again, we don't have a point system. We don't know exactly what it is. There's lots of innuendo and hypotheses and stuff, but what we know for sure is that, boy, there's not a ton of traders and they always seem to be getting audited. That's my experience. It's because they're filing their expenses on something called a Schedule C. So they're saying, I am a trader business, but they put their income on Schedule D. So you have these Schedule Cs, which is a sole proprietorship, and they're constantly showing expenses with no income on that form. And I believe that's probably kicking it out. And the IRS says, well, wait a second, you have capital gains over here and you have these ordinary expenses. That doesn't compute because there's no such thing in the Internal Revenue Code as a trader. It's never really been defined. It was somebody was putting trader on their return, and then the IRS kind of accepted it as this thing, and that you always have to go to the courts to get an interpretation because it's a facts and circumstance test. So like if you want to go to court quickly, this is how you do it. If you want to get, hey, I've always wanted to go to court, and I just love that tax court. This is a way where they're putting in front of a judge saying, here's the facts. The IRS and the taxpayer usually are somewhat on agreement of the facts, and then usually the taxpayer gets struck down. In fact, almost every case, because they find some reason. It's this. I'm not going to dive into all the nuances of trader tax, but they have about 3 different ways that they can undo you. And then if you do qualify, in order for you to be able to take write-offs against your other income from Schedule C, is there has to be something called a mark-to-market election, which most people don't make. They don't know they have to, and they don't get any of the losses. So usually it's somebody who lost their katush trading in the market, doing an option trader, and they get crushed. And they go and they say, I want to offset my other income, my W-2 income, because it's not fair that I have to carry forward that loss and I can only use $3,000 a year. That's all you can write off of capital losses against your other income. And they get mad about it, and they take it all anyway. And the IRS says, no, actually you can't. You got to spread that out over a long period of time. And then they go to court and they fight it out. So that's a big one. Another one that I see a lot of, and I'll just kind of put it over here, is your Schedule C filers as a whole. And the thing about sole proprietors specifically is they haven't really separated their business from themselves. And so the IRS looks at them kind of as an alter ego, and they say we don't know where the business starts and the individual ends. And so the IRS is going to say, we need to see all your records to back it up. And a lot of those folks are sole proprietor for a reason. It's because they were doing it on the cheap and they didn't have professionals. Because the professional is going to say, if it looks like a duck, walks like a duck, the IRS is going to say it's a duck. If you're putting it on your individual return and you meshed it in, you have the same bank account, you're not even a separate entity, it's probably not a business. It looks more like an individual, and they're going to treat it that way. Here's what happens. Let's say that I'm somebody that makes money as a sole proprietor. So I'm going to exclude the people that don't make any money or that make a smaller amount. Let's say you make 50 grand a year. This doesn't necessarily apply to you. You're just losing money by being a sole proprietor, but it's not necessarily increasing your audit rate significantly, although it is probably, actually going off the top of my head, it's about 300% more likely to be audited than the option I'm going to give you as the counter, which is an s-corp. But where it really gets nasty, and this was off of form or table 17B of the old data books, because they discontinued that form for 2020, tax year 2020. I'm sitting here in 2022, but they discontinued it for the last tax year that we have all the data, which really stinks because I used to love to get into the minutia, but they quit publishing it. If you're making money as a sole proprietor, you were essentially 800% more likely to get audited. And went a little higher. Some years it was astronomically higher. Other years it was a little bit higher. 800 was the low end. I've seen it 1200%, but let's just call it 800% more likely, 8 times more likely to get audited. But the bad part, and I say 800% more likely to be audited than if you operated as an s-corp. That would be the other option. It was 0.2%, 1.6% for the sole proprietor. So it was a fraction of a percent, 0.2%, which is what? I don't even know what the number is. It means 2 out of 1,000, something like that. Yeah, 2 out of 1,000 would be right. It was the change rate that used to set me off. The change rate when the IRS audits a sole proprietor meaning how often they come in and change and add additional tax, is 94 to 95% of the time when they're audited. So the IRS isn't just going in there blindly and saying, oh, I'm just going to randomly grab people. There was definitely something triggering that audit. There was something. We just don't know what, because we don't know what the discriminant function system, how that little code is. It's kind of like the secret code formula for Coca-Cola, right? Lots of people are trying to recreate it, but we really don't know. So they're looking at it. So it's always kind of like this, I have no idea. All I know is that if you look like this, they tase you. So don't look like this. Right? It's actually that simple. It's hey, if you wear a red hat, they punch you. So don't wear a red hat. I shouldn't use that because people are gonna think it's political. Hey, if you're wearing a green hat, they walk up and they whip you with a towel, and that hurts. Don't do it. Right. All right. So that's or the old thing. I go to the doctor, says it hurts when I do this. Well, quit doing that. Right. So you could actually see who they're going after using that system. Now, here's some big numbers that you'll actually want to pay attention to. I think it's 72% of audits are correspondence audits. 72% are done via letters. And it usually means somebody forgot to attach a 1099, a 1098, a K1, a W2, or something's not matching up. Somebody reported something and you didn't put it on your return, and it's confused the IRS, so they're asking for clarification. Sometimes they just send you a letter saying, hey, we got a 1099 that you didn't include, so we're going to add it on. Unless you have another reason, please pay the bill. That's an audit. I mean, it sounds more like a math error, but that's 70%. And by the way, the actual audit rate for all taxpayers, individuals, I should say, is about 0.6. It's not massive. So it's less than a 1% chance. And of that 0.6, 70% are correspondence audits. So what are your chances of being called into an auditor's office and having to provide all the backup documents? It's really low. What are the chances of me being marched in where I have to show up? Maybe I have to get an accountant, and now I have to go meet with an agent with my accountant. That is a really, really low chance. I mean, we're talking about once in 500 years. It's a minimal chance. So what I want you to do is be able to say, like, hey, relax, keep good records. If you know that there's certain groups that the IRS is targeting, don't be one of those groups. Right? The IRS will send us every year they do this dirty dozen list. They're like, here's people that we think are, up to no good or have to do a listed transaction or there's abusive transactions. Most of those, when they're doing that, like let's say it's conservation easements, it's not you that they audit. They actually go and they audit the promoter of that to make sure it's a legitimate tool. Because believe it or not, there's bad people out there that promote things that are not legal, right? That doesn't mean that you're getting in trouble. It just means that somebody might be overstating, and then they come in and they adjust it, and they say, "Hey, you, like in a conservation easement, it's really 4-to-1. It's kind of, it's about the top end. Hey, if I give $1, I might get a $4 deduction. Is that worth anything to me? It depends on how high your tax bracket is, but it's not a huge benefit either way. Some people go 15-to-1, which is ridiculous, right? And they might go back and look at it and say, no, you overstated that value. It's actually 4-to-1. And then they would just alter your, hey, you owe some tax. You took too big of a tax deduction. That's the type of thing that usually happens in that case. The dirty dozen list is usually not you. It's somebody being looked at. And then the other group that likes to get audited a lot is really people making over, if I looked at the entire group and I said, what was there a number where it was significantly higher than others? And it's, get this, $10 million. $10 million, you're at a 7% audit rate. $10 million and above. It's very few people. It's still just a few thousand audits a year. I mean, it's a minimal amount, but there's so few of them that are available. that comes up. So you'll see that where they're significantly higher. How many audits a year are there, by the way? So in the last data book for 2020, the number was 509,000. Maybe closer to 506. It was like there was 500, or excuse me, maybe 510. It was 509 and some change. If I remember right, it was a high number of change. So maybe closer to 510,000 out of what, 160 million returns. It's a really small number, guys. Really small number. So I'll just repeat this again. Do not worry about audits. We can see who gets audited. We just want to make sure that you don't look like the people that get audited. This little system is based off of historical data. So, for example, a firm like ours doing 10,000 returns a year, we don't get audits. We get very few. So we're just going to keep doing that because we know that it doesn't trigger audits. If in anybody's practice you started seeing audits like, oh, hey, the real estate professionals always get audited. Okay, we would just say, hey, by taking this deduction and putting this on your return, you just have a higher level of scrutiny. Like you might get audited once every 100 years. That would be a high audit rate, by the way. Anything over 0.5%, you might be considered in a higher audit rate. The average is 0.6. And in some 12-month periods, it's been as low as 0.4 in the last 2 years. So depending on what period of time you're looking at, it's really low. And we might say, hey, you're pushing yourself into a group that's maybe 2%, or it's maybe over 1%. Maybe we don't even know because there's no data on it. And we just say, hey, look, let's say it's 2%. One times every 50 years, you're going to have to justify this thing, right? Just make sure you're keeping good books and records. And that when you take those deductions, you make that claim that you can back it up. That's what your accountants are there for. So make sure you're doing these things. So like usually in our situation, if we're making a real estate professional statement, we're going to make sure that there's records to back it up. We're going to ask you the question. We teach it all the time. So we give you here's all the things that you do. Make sure that you're keeping a time log. Make sure that you hit these requirements. People aren't just doing it out of the blue. And if we're doing a cost seg, it's going to be a professional engineering study. There's going to be the engineering study available so that before we even do it, either it's been engaged and we have an estimate, and that's what we're using. But if you file the return, you're having a hard number saying this is what the engineering study actually came out. And then you just don't have to worry about it because that's what they're looking for. So you get an audit, they're going to say, do you have this information? You say, yes, right here. Boom, it's over. I can just tell you we have very, very few audits. We haven't had any go awry because we have everything already set up. If it's a business, just make sure you're keeping good books. If you're taking an expense, make sure you know what the expense is and make sure that you have the appropriate documentation. Keep it in your folder or keep it on your computer. Like you can use you don't have to keep the physical version of all these things of receipts and whatnot. You can make electronic versions and then just store it. And in the unlikely event you're ever selected, and remember, of that number, it was probably about 0.6. So I'll put 0.4 to 0.6. That's your audit rate. In the event that you're ever audited, about 70% of those plus are going to be correspondence audits, which means they're just asking for some sort of explanation, some sort of backup. It's over. In the unlikely event they need to talk to you more, then they might be going through more. They might be doing, going through and saying, hey, I need some more records, in which case you get your accountant in. That's what we do for our clients. It's not hard. And then groups like us, we usually add audit protection into our returns for a really small amount, or it's included, in which case you don't have to worry about it anyway, because we don't want you dealing with it. As the preparer, I just tell you, our CPAs and our EAs and our accountants, they're going to say, let us deal with it. I don't want you to create a mess. Somebody may be well-intentioned, but there might be a term of art being used, or they're saying, hey, we didn't receive this document, and I don't want you having to sit there and try to figure out what it is. Usually we know pretty quick. We're able to say, all right, here's what they're looking at. Here's what caused the issue. Here's the resolution, and it's done very, very fast.